Listen carefully, set aside whatever you're holding, minimize those browser windows, and focus on what I'm about to show you. Pull up the price display on your device. What number appears? Chances are you're seeing something hovering near $71. My name is John AGI, and I report from Currency Archive. When you check the COMEX spot quotation, the London benchmark, or any mainstream Western data feed, you'll observe a figure lingering in the lower $70 range. Technical traders among you are likely mapping resistance zones, identifying trend lines, and convincing yourselves the market is in a consolidation pattern. You believe silver is maintaining its position. I'm here to reveal an uncomfortable truth. That figure on your display is fiction. This isn't a minor discrepancy. This isn't simply delayed information. This is a mirage, a phantom reading from a dying mechanism that hasn't acknowledged its own demise. At this very moment, on the opposite side of our planet, in Tokyo's physical marketplaces, the situation is drastically different. We're getting verified on-the-ground intelligence from our Japanese contacts indicating that tangible silver bars, the actual metal you can physically possess, the commodity that shields you from monetary debasement, are exchanging hands for substantial yen amounts. Let's perform this currency calculation together. Using today's exchange rate, this converts to approximately 130 US dollars. Absorb that information, $130. Now glance back at your monitor. $71. We're looking at a $59 gap. This represents an 83% markup. Throughout the entire chronicle of contemporary financial systems, such an extreme divergence between spot pricing, supposedly reflecting the commodity's universal value, and street pricing, representing what buyers actually surrender to acquire it, has never materialized. An 83% differential isn't market friction, it's market collapse. It's the economic version of cardiac arrest. A 2% spread represents standard operations, the dealer's commission. A 5% spread signals elevated demand. A 10% spread indicates supply constraints. But an 80% spread reveals complete systemic rupture. The linkage connecting paper markets to physical markets has severed. The connection cable has snapped. The lift is plummeting and impact approaches rapidly. Now, I anticipate the doubters' responses. I can already envision the objections. John, you're overstating this. Japanese taxation is substantial. Consumption taxes exist. Fabrication carries costs. Transportation requires payment. You cannot equate a 1,000-ounce industrial bar in Manhattan with a 1-ounce retail piece in Tokyo. To those voices, I respond, you're fundamentally missing the point. Certainly, transaction costs exist. Value-added taxes are real. Minting requires resources. However, friction doesn't account for $59 per ounce. Stamping silver doesn't cost $59. Shipping silver across the Pacific doesn't require $59. Even combining every tax, insurance premium, and production expense, you might reach $10, perhaps $15 at maximum. Where does the remaining $45 originate? It emerges from fear. It stems from scarcity. It arises because the Japanese yen is collapsing, and Japanese citizens, traditionally among the planet's most dedicated savers, are evacuating their positions. They're abandoning currency and rushing toward tangible assets regardless of cost. The COMEX quote of $71 is irrelevant to them. They understand that attempting purchases at $71 yields zero availability. The spot quotation represents a contract settling in currency. The street quotation represents the survival price. And currently, survival costs $130. This divergence constitutes definitive evidence that arbitrage mechanisms have ceased functioning. In properly functioning markets, financial institutions, the sophisticated capital, operate as balancing forces. When silver trades at $71 in Manhattan and $130 in Tokyo, institutions like JP Morgan or Goldman Sachs should mobilize aggressively. They should acquire every available ounce at the COMEX for $71, emptying Manhattan storage facilities completely. Subsequently, they should arrange air freight, transport that metal to Tokyo, cover taxation and fabrication expenses, then sell at $130. After all costs, they'd capture risk-free profits of $30 to $40 per ounce. On a million-ounce position, that's $30 million of guaranteed returns. Banking institutions don't ignore $30 million opportunities. They aggressively pursue such arbitrage. Yet this trade isn't happening. Why? Because execution is impossible. The infrastructure is blocked. The supply chain connecting 10-pound commercial bars in Manhattan vaults to Asian retail markets has fractured. Insufficient refining capacity exists to transform large format bars into small format products quickly enough to satisfy demand. Secure air transport is inadequate. Most critically, Manhattan's supply isn't as accessible as appearances suggest. If an institution attempted withdrawing 10 million ounces from COMEX storage facilities today for Tokyo shipment, they'd trigger system failure. The exchange would intervene, forcing cash settlement instead. Therefore, arbitrage is impossible. Banks remain trapped in the paper dimension. Retail purchasers remain trapped in the physical dimension, and the bridge connecting them has been destroyed. This phenomenon is called bifurcation, the world splitting into dual realities. In reality A, the paper universe, silver appears inexpensive and abundant. Trading occurs via mouse clicks. Technical charts appear bearish. Price, $71. In reality B, the physical universe, silver is rare and vanishing. Delivery requires 6-week waiting periods. Massive premiums are mandatory. Charts show vertical trajectories. Price, $130. You must determine your reality. Paper traders inhabit reality A, examining account balances and questioning their returns. Stackers inhabit reality B, holding assets effectively trading at double the market rate in actual commerce. Financial collapse history teaches one lesson consistently. Reality B ultimately prevails. Paper markets can suppress pricing temporarily, but cannot suppress physical shortages indefinitely. Eventually, paper markets exhaust their leverage capacity, and both prices converge violently. They don't meet halfway. Paper prices always chase physical prices upward. Manhattan will rise to meet Tokyo. Tokyo won't descend to meet Manhattan. However, we must approach this narrative carefully. Observing this 80% anomaly and immediately declaring institutional death would be premature. Declaring that JP Morgan holds short positions at $71 while actual prices reach $130, therefore they're insolvent and collapse is imminent. This oversimplifies reality. I observe the dramatic headlines, the social media proclamations, bankruptcy, implosion, terminal. I'm stating clearly it's far more complex. Certainly institutions are suffering. Certainly they're hemorrhaging capital. But believing a bank possessing $1.5 trillion in Tier 1 capital will collapse from several billion in silver losses underestimates your opponent. You're underestimating their protective armor. Understanding how this squeeze actually unfolds, why it becomes a prolonged, grinding conflict rather than an overnight celebration, requires examining the giant's balance sheets. We must analyze the survival mathematics, because institutions aren't dead, they're wounded. And wounded creatures pose the greatest danger. Let's examine their survival equations. Opening the latest Commitments of Traders report from the CFTC, the document tracking precise position holdings at the COMEX, reveals a figure that initially appears catastrophic. The commercials, the diplomatic term for bullion banks including JP Morgan, Citibank, and Bank of America, currently maintain approximately 40,000 contracts in net short positions. Let's calculate. One contract equals 5,000 ounces. 40,000 multiplied by 5,000 equals 200 million ounces of silver. That's the bet's magnitude. Their wagering prices will decline or stabilize across 200 million ounces. Currently, prices aren't stabilizing, they're surging. Should silver move from $71 to $100, a roughly $30 increase, you multiply that $30 loss by 200 million ounces. Result, $6 billion. $6 billion in mark-to-market losses. In typical circumstances, a hedge fund losing $6 billion overnight faces liquidation. Their assets would be auctioned. Their leadership would testify before Congress. It's a catastrophic figure. This explains the internet firestorm, the social media declarations that Bank of America is insolvent or JP Morgan is cornered. The mathematics suggests they're underwater. The calculations indicate that each dollar silver advances bleeds another 200 million in immediate cash. But here's the uncomfortable reality the anti-establishment crowd ignores. $6 billion represents a rounding error for these entities. You must grasp the scale of our adversary. We're not confronting a modest family investment office. We're confronting systemically important financial institutions. Let's examine their protective layers. Let's examine their Tier 1 capital. Tier 1 capital represents a bank's fundamental financial strength, their equity, retained earnings, the reserves they maintain to absorb shocks. JP Morgan alone maintains a Tier 1 capital buffer approaching $300 billion. The combined assets of America's 4 largest banks exceed $10 trillion. Compare these figures. On one scale, a $6 billion silver loss. On the other scale, a $300 billion safety cushion. The silver loss represents perhaps 2% of their protection buffer. Does it hurt? Absolutely. Does it devastate their quarterly reporting? Certainly. Shareholders will express fury, compensation will be reduced, traders will be terminated. But does it bankrupt the institution? Does it force closure and surrender to retail investors? No, it resembles experiencing a flat tire. Is it inconvenient? Yes. Does repair cost money? Yes. Does it mean abandoning your vehicle permanently and walking indefinitely? No. You possess a spare, you carry insurance, you hold a credit card. Bullion banks possess the ultimate credit card, the Federal Reserve. Another survival layer exists that rarely gets discussed. The hedge. We observe COMEX short positions and assume naked shorts, meaning they sold silver they don't possess for speculation. But banks aren't gamblers, they're bookmakers. And bookmakers always balance their books. While they're short 200 million ounces on COMEX, the visible market, they're likely long hundreds of millions in the OTC market, the over-the-counter market invisible to public scrutiny. Consider bank operations. A Mexican silver miner extracts metal. They want price certainty for payroll. They contact JP Morgan. We'll sell 10 million ounces at $70. JP Morgan accepts. Now, JP Morgan is long 10 million ounces of physical silver or forward contracts. But JP Morgan doesn't want price exposure. They want transaction fees. The response? Short 10 million ounces on COMEX. Now they're neutral. Price increases mean COMEX short losses, but minor contract gains. The two offset. That 40,000 contract short position visible in CFTC reports might largely represent hedges against actual physical metal contracted from miners. When prices surge to $100, they lose $6 billion on COMEX, but their minor contract values gain $6 billion. Net loss? Zero, or nearly zero. I'm not claiming perfect hedging. They take risks. They play games. Definite naked exposure exists. Likely a speculative portion of that short position is bleeding profusely. Perhaps they're unhedged on 50 million ounces. That's a $1.5 billion impact. That stings. That's painful. That explains liquidity injections. That explains repo market stress. They need immediate cash for short-side margin calls while awaiting long-side payouts. This is a liquidity crisis, not a solvency crisis. There's a massive distinction. Liquidity crises mean you're wealthy but temporarily cashless. Solvency crises mean you're broke. Banks face liquidity squeeze. They need immediate cash to feed the COMEX mechanism, but they're not broke. This distinction is critical for your strategy. Believing banks will collapse tomorrow might encourage reckless betting. You might purchase call options expiring next week, thinking this is the collapse. Then banks deploy capital, meet margin requirements, survive, and use algorithms to crush prices back to $70 temporarily, shaking you out. They possess staying power for attrition warfare. They can absorb pain longer than you can maintain solvency if you're leveraged. This is painful deleveraging, the correct terminology. They're unwinding bad positions. They're absorbing losses. They're retreating from the market. Why do you think prices rose from $20 to $71 initially? Because banks are ending suppression. They're recognizing that fighting the trend is too expensive. At $20, price suppression was easy. At $71, with looming shortages, suppression costs billions in collateral. So they're withdrawing. They're allowing price increases, but executing it in controlled, managed fashion. They're managing the retreat. They're not dying. They're repositioning. And don't forget the final safety net, the rulebook. If conditions truly deteriorate, if silver gaps to $200 overnight and the $6 billion loss becomes $60 billion, do you believe the exchange will simply let institutions fail? Do you believe government will permit financial system collapse over precious metal? No, they'll modify the rules. We've witnessed this previously. In 1980, when the Hunt brothers cornered silver markets, the exchange changed rules to liquidation only. You could sell but couldn't buy. They broke the Hunt brothers to save institutions. In 2022, when nickel markets exploded on the LME, they simply canceled trades. They reversed time. They declared those transactions never occurred. If silver goes vertical to levels threatening JP Morgan's solvency, COMEX will declare force majeure. They'll halt trading. They'll force cash settlement at a fixed price. They'll announce the price is $75. Everyone settles here. Market closed. This is why I emphasize don't play their game. If you hold paper contracts betting on collapse, they can modify contract rules. If you hold physical metal, they cannot alter physics. They cannot cancel the bar in your safe. But while playing in their casino, the COMEX, the house always wins. Or at minimum, the house never dies. Erase the bankruptcy narrative from your mind. It's fantasy. Institutions will survive. They'll limp away bloodied with reduced compensation, but they'll survive. However, their survival mechanism, their retreat, precisely clears the path for silver's ascent. They're no longer the wall-blocking price. They're becoming the speed bump. They're stepping aside because manipulation costs now exceed manipulation benefits. Why have costs risen? Why is shorting the market suddenly dangerous? Because of the physical variable. Because of the one element they cannot hedge, cannot print, cannot regulate away, the supply shock. Institutions can manipulate paper indefinitely, but cannot manipulate when physical metal stops arriving at the dock. And that's precisely occurring today. The real threat to suppression schemes isn't institutional balance sheets. It's the China wall. Today, January 1st, new Beijing laws became effective. While we focused on bank stocks and premium spreads, the Chinese government quietly closed the gate. This is the structural break altering the equation for the next decade. Let's examine the pivot. Let's examine the red dragon. This brings us to the pivot, the moment when narrative shifts from financial engineering to geopolitical reality. We've spent recent minutes analyzing Western bank balance sheets, debating whether their $6 billion loss is fatal or merely painful. But while distracted by the paper fire in Manhattan, the real arsonist was igniting a match in Beijing. Because today is January 1st, 2026. Examine the calendar. It's not merely a New Year's start. It's a new era in resource nationalism. As of this morning, new Chinese export regulations regarding strategic dual-use metals are officially active law. With a pen stroke, the world's largest producer and consumer of refined silver has effectively erected border walls. You must understand what just transpired. Media calls it export licensing. They're using gentle language. They're claiming China isn't banning silver exports, just requiring licenses to ensure quality control. Don't be naive. Licensing is bureaucratic code for soft prohibition. Under these new rules, which we've translated and analyzed, the only entities permitted to export silver from China are mega refiners, the massive state-owned enterprises reporting directly to central government. The hundreds of smaller private refineries, scrap recyclers, trading houses that previously flooded global markets with excess silver, they're cut off. They cannot obtain licenses. They're now forced to sell domestically. And the mega refiners? Technically they can export, but practically they won't. Why? Because their mandate has changed. For the last 20 years, their mandate was profit. Their job was refining silver and selling to the highest bidder, whether Apple in California or London bullion dealers. Today, their mandate is strategic security. Their job is ensuring Chinese solar industry, Chinese electric vehicle industry, and Chinese military complex have first access to every ounce produced within the People's Republic. They'll only export surplus. And here's the terrifying reality. There is no surplus. China currently runs a massive internal silver deficit. They produce roughly 3,500 metric tons annually from domestic mines. But their industrial machine, the beast churning out 80% of global solar panels, consumes over 6,000 tons yearly. Calculate 3,500 minus 6,000. They're running a deficit of 2,500 tons. Previously, they filled this gap by importing ore, refining it, and sometimes exporting finished bars to balance trade flows. But now, with solar demand exploding, specifically new TOPCon and HJT panels using 50 to 80% more silver per watt, their internal hunger is insatiable. They need every mined ounce and every imported ounce. Exporting silver from Beijing's perspective is treason. It's selling future fuel to adversaries. The wall is real. It's not concrete and rebar. It's a regulatory wall of refusal. Bullion banks like JP Morgan, tech giants like Tesla, who relied on steady Chinese silver streams to balance global markets, are waking today to silence. They're calling Shanghai suppliers and hearing, "Sorry, license approval is impossible. Sorry, the Ministry of Commerce has flagged this shipment. Sorry, domestic demand has consumed the entire lot." This creates permanent structural deficit for the West. You must realize how fragile Western silver markets actually are. The United States doesn't mine sufficient silver to meet its own demand. Neither does Europe. We're deficit regions. We depend on imports from Mexico, Peru, and China to maintain operations. Remove China from the equation, remove one of three stool legs, the stool collapses. It means the West must compete for remaining supply from Mexico and Peru. It means Western premiums must rise permanently to attract metal. This isn't a temporary squeeze lasting weeks. This is rewiring global metal flows. For decades, silver flowed from east to west. Starting today, the river stops. In fact, the river might reverse. We might see China bidding aggressively for Mexican silver, competing directly with U.S. buyers. And this is where industrial panic moves from slow burn to wildfire. We discussed Samsung and Tesla in previous updates. But consider second-tier companies. Consider medical device manufacturers, 5G infrastructure builders, aerospace defense contractors. They lack Tesla's political connections. They lack Apple's balance sheet. They relied on open spot markets. They relied on clicking buttons and buying silver at London fixed price plus 10 cents. That world died today. Now they are confronting a market where spot price is $71, but China price is $110, and Japan price is $130. They're watching global inventory get sucked into the Asian black hole. This creates a psychological shift called inventory hoarding. They overorder. If they need 10,000 ounces for February, they order 20,000 for safety. Because excessive silver incurs small costs, storage fees, but no silver incurs fatal costs, factory shutdown. This behavior amplifies shortage. It creates self-fulfilling prophecy. Once one company starts hoarding, everyone else must hoard or be left with nothing. We're seeing early signs now. Phantom demand is rising. Orders are being placed not for consumption, but for safety. And this phantom demand is hitting a market that just lost its biggest supplier. This is the real squeeze trigger. Banks can manipulate paper prices on COMEX because it's a closed loop of digital contracts. But they cannot manipulate the fact that an Ohio factory needs physical silver to manufacture cruise missile guidance systems, and that silver currently sits in a Shanghai vault that just locked its doors. Banks cannot print silver bars, and banks cannot force Chinese exports. For the first time in history, Western financial elites are powerless against physical reality. They can print dollars to bail out shorts, but those dollars are useless if there's nothing to buy. What good is $1 billion if the seller says, "Not for sale"? This leads to industrial base bifurcation. Companies with factories inside China, like Tesla's Shanghai Gigafactory, are safe. They can access Chinese metal. They can pay local prices and continue operations. Companies with factories in the US or Europe are in the kill zone. They're cut off from Chinese supply. They're forced to source from the shrinking Western pool. This will drive Western premiums to match Eastern premiums. It must. If silver is $130 in Japan, why would a Mexican miner sell to a US refiner for $71? They won't. They'll ship it to Tokyo. Capital flows to best treatment. Commodities flow to highest payment. Unless COMEX pricing rises to match Asian pricing, COMEX will be drained of every ounce. Miners will bypass Manhattan. Refiners will bypass London. They'll sell directly to desperate Eastern buyers. And this brings us back to institutions. Remember in part 2, we said they're not dead because they have Tier 1 capital. That's true. They have money. But money cannot solve logistical blockades. JP Morgan can write a $5 billion check to cover their short position. But if their client stands for delivery, if the client says, "I want the metal, not the cash," JP Morgan is in trouble, because JP Morgan cannot get licenses to export silver from China either. The capital armor protects them from insolvency, but doesn't protect them from delivery default. Doesn't protect them from the embarrassment of telling a client, "We don't have it." And that's the weak point. That's the thermal exhaust port on the Death Star, the inventory. Banks can handle price squeeze. They can't handle inventory squeeze. If COMEX vaults run dry, if the registered category hits 0, the game stops. The infinite liquidity illusion breaks. And thanks to the China wall, the replenishment rate for those vaults just dropped to 0. No new metal is coming from the East to save them. They're on their own. They're fighting a war with remaining bunker ammunition, and supply lines have been cut. So how much ammunition do they actually have left? How close are we to that 0 moment? We hear numbers thrown around. 100 million ounces, 50 million ounces. But we need to examine the real number, the number available for immediate delivery, the registered category. Because when you peel back layers of COMEX reports, you realize that most silver in those vaults doesn't belong to banks. It belongs to investors who aren't selling. The amount of liquid silver available to stop this panic is terrifyingly small. It's not an ocean, it's a puddle. And the sun is beating down. Let's examine the thin ice. Let's examine specific inventory data proving COMEX is running on fumes. Because when you see how little actually remains, you'll understand why premiums are 80%. You'll understand why the market is terrified. Let's open the vault. And when we finally pry open the heavy steel doors of COMEX depositories in Manhattan, what we discover inside isn't a fortress of infinite wealth. It's not a mountain of silver bars stacking to the ceiling, ready to flood markets and crush speculators. What we find is hollow echo. We find a crime scene where evidence has been systematically removed, bar by bar, truckload by truckload, until only dust remains. We need to discuss the number, 38 million. According to the latest Daily Warehouse stock report, released quietly during New Year celebrations, total registered silver in the COMEX system has fallen to 38,200,000 ounces. Now, to average people, 38 million ounces sounds substantial. It sounds like a dragon's hoard. But you must view this number through the lens of global markets. The world consumes roughly 1,100,000,000 ounces of silver annually. That averages approximately 3 million ounces of consumption daily. So calculate. 38 million ounces divided by 3 million ounces per day. 12 days, that's it. The global benchmark for silver pricing, the exchange supposedly setting value for the entire planet, is sitting on less than 2 weeks of global supply. If mines stopped producing tomorrow, or if transport ships stopped sailing, COMEX would be bone dry in 12 days. This isn't a buffer, this isn't a reserve, this is thin ice. And the ice is cracking under the weight of demand we just discussed. But the situation is actually far worse than that headline number suggests. Because banks play a shell game with inventory data to make it look healthier than reality. They'll point to total inventory, usually around 270 million ounces. They say, look, there's plenty of silver, panic is unnecessary. But they're lying by omission. Because inside that total number, there are 2 categories, eligible and registered. Registered is metal actually available for delivery. It has a warrant attached. It's ready to be sold to fulfill contracts. That's the 38 million ounces. Eligible is the rest, roughly 230 million ounces. Eligible simply means the metal meets purity standards and is sitting in the vault. It doesn't mean it's for sale. That metal belongs to private investors, family offices, people like you and me who simply pay the vault a storage fee. Banks cannot touch it. They cannot deliver it to cover shorts unless the owner decides to sell. And ask yourself, if you own silver in a COMEX vault and you see the Japan price is $130, but the bank wants to pay you $71, are you selling? No, you're holding. Or you're withdrawing. So the eligible pile is effectively frozen. It's dead weight. The only liquidity in the system is that tiny, shrinking pile of 38 million ounces in the registered category. This is where economic gravity takes over. We call it Gresham's Law. You may have learned it in Economics 101. Bad money drives out good. But in silver market context, it means fake paper prices drive out real physical metal. When a commodity is priced artificially low, when it's subsidized by paper manipulation, the market will drain physical supply until nothing remains. Think about it. COMEX is essentially a store selling silver for $71. The rest of the world, Japan, China, the UAE, values that same silver at $100 or more. What happens when a store sells iPhones for $500 when they're worth $1,000 everywhere else? You get a run on the store. Smart money, arbitrageurs, industrial buyers, sovereign wealth funds will stand for delivery on COMEX, not because they want to crash the system, but because it's the cheapest place on earth to buy metal. They're looting the vault, legally. They're using the bank's own suppression scheme to strip mine the exchange of its assets. This is why inventory is plummeting. It's not an accident. It's the direct mathematical consequence of price suppression. Banks are victims of their own success. They suppressed pricing so effectively that they made silver the most undervalued asset on the planet, and now the world is backing up the truck to take it away from them. Every time they smash the price down to $71 to save their short positions, they inadvertently ring the dinner bell for physical buyers. They're shouting flash sale, silver at a discount, and buyers are responding. Withdrawals are accelerating. We're seeing loadout notices, requests to physically remove metal from the vault system, hitting levels we haven't seen since the silver squeeze of 2021. But this time, inventory is starting from a much lower base. And here's the terrifying part for the shorts. The refill mechanism is broken. In the past, when registered stocks got this low, down to 30 million ounces, the price would rise slightly and metal would flow in from London or China to replenish stock. Eligible holders would be tempted to sell. Miners would ship extra bars. But today, we just established in part 3 that China is closed. No metal is coming from the east. And the eligible holders? They're looking at inflation data. They're looking at war drums. They're looking at premiums. They're not selling at $71. They're waiting for triple digits. So the refill isn't happening. The drain is one way. It's a bathtub with the drain open and the faucet turned off. It's mathematical certainty that the water level will hit 0. So what happens when it hits 0? What happens when registered drops from 38 million to 10 million and then to 0? Does the world end? Does COMEX explode? No, the system protects itself. This is where the paper game reveals its final trick. The exchange will likely declare a suspension of physical delivery. They'll cite logistical bottlenecks or market irregularities. They'll invoke the force majeure clause in the contract, and they'll say to the people waiting for their metal, "We're very sorry, we cannot give you the silver bars, but good news, we'll give you the cash equivalent." They'll settle the contract at $71. They'll force you to take the paper currency you were trying to escape. This is the moment of default. It won't be called a default on CNN. They'll call it a settlement procedure. But to anyone who understands what money is, it's a default. If you bought a car and the dealership took your money and then said, "Sorry, no car, here's your money back," you'd be furious. But at least you'd have your money. But in the silver market, getting your money back is a disaster. Because while you're holding your $71 of cash settlement, the real price of silver in the physical market, the price you have to pay to actually get metal, will be gapping to $150. You'll be priced out forever. You'll be left holding a bag of depreciating fiat currency, while the asset class leaves the solar system. This is why inventory data matters so much. 38 million ounces is the countdown clock. Every million ounces that leaves brings us one day closer to that cash settlement moment. And smart money knows this. That's why the drain is accelerating. It's a game of musical chairs. There are thousands of paper contracts, but only 38 million ounces of metal. When the music stops, and the music is stopping right now, only the people sitting on physical bars will win. Everyone else gets a check that can't buy anything. And don't underestimate the speed at which this can unravel. In a panic, inventory doesn't drain linearly. It drains exponentially. The moment the headline hits, COMEX registered silver falls below 20 million, the psychological dam will break. Hedge funds that usually trade paper will say, "Get me the metal out now." Industrial users will say, "Secure inventory regardless of cost." We could see that remaining 38 million ounces vanish in a single week. We saw it happen with nickel. We saw it happen with palladium. When the bottom falls out, it falls out all at once. So we have a banking system bleeding liquidity, but armored with capital. We have a Chinese supply shock that has cut off the flow of new metal. And we have a COMEX vault running on fumes, sitting on less than 2 weeks of supply. This is the perfect storm for structural repricing. But it's not going to be a straight lineup. Banks are not going to roll over and die. They're going to fight. They're going to use every weapon in their arsenal to make the path to $100 as painful, as volatile, and as confusing as possible. They're going to try to shake you out before the payoff. How will they do it? What's the roadmap for 2026? How do we get from $71 to $100 without getting liquidated along the way? We have to examine the tactics of managed retreat. We have to examine the war of attrition, because the next 12 months will not be a party. They will be a grind. Let's examine the roadmap. The data is overwhelmingly bullish. If you input this data into a computer simulation, silver's price would gap to $100 tomorrow morning. But markets are not computer simulations. They are battlefields. And the enemy you're fighting, the consortium of bullion banks and the exchange itself, has not surrendered yet. They are retreating, yes. But a retreating army often plants landmines. So I need to shatter a dangerous illusion right now. There's a fantasy circulating on social media that because inventory is low and shorts are trapped, we're going to see a vertical explosion. People think we're going to wake up Monday morning and see silver trading at $100. They think it will be a straight line up, a God candle that solves all their financial problems in 24 hours. I'm here to tell you that's not going to happen. The path to triple digits in 2026 is not going to be a rocket launch. It's going to be a grind. It's going to be a dirty, volatile, exhausting war of attrition designed to strip you of your position before the finish line. You have to understand the difference between direction and control. Banks have lost control of direction. The supply shock from China and the inventory drain means the price must rise. Market physics demand it. But banks still control speed. They still own the casino. They still set margin requirements. They still control algorithms. They're going to use that control to ensure the rise from $71 to $100 takes as long as possible and inflicts maximum pain on leveraged speculators. How will they do it? What weapons do they have left? Their first weapon is volatility. Expect price action to become violent. We'll see days where silver rallies $5 in the morning, only to crash $7 in the afternoon. Why? Because banks know retail traders love leverage. They know you're buying call options. They know you're trading futures with 10-to-1 margin. So they'll engineer sudden terrifying drops, flash crashes to trigger your stop losses. They'll smash the price from $75 down to $68 in 10 minutes, just to wipe out the longs, then let it float back up to $75. This is called running the stops. It's how they generate liquidity. They force you to sell your position at a loss, and they buy it back to cover shorts. If you're holding paper contracts, you're standing in the middle of a highway trying to pick up pennies. You'll get run over. Their second weapon, and this is the nuclear option, is margin hikes. We've already seen this begin. COMEX has quietly raised margin requirements, the amount of cash you need to put down to hold a contract, twice in the last month. They'll do it again. When silver hits $80, they'll double the margin. When it hits $90, they might triple it. Why? They'll say it's to ensure market stability. But the real reason is to price out the little guy. If it costs $10,000 to hold a single contract, retail traders can afford it. If they raise it to $50,000 overnight, retail traders get margin calls. They don't have the cash. They have to sell. Who has the cash to meet the new requirement? The banks. By hiking margins, they force weak hands to fold, leaving only institutional players at the table. They effectively gentrify the bull market. They clear the room so they can enjoy the ride up without you. This is why I warned you in part 2 about the bank death myth. If you bet on them dying tomorrow, you will lose. They have capital to survive the margin hikes that they themselves impose. You do not. So what does the roadmap actually look like? I believe we're entering a phase of stair-step repricing. We won't go straight to 100. We'll grind up to $80 and then we'll chop sideways for 3 months. It will be boring. It will be frustrating. The news will say the silver rally is over. This boredom phase is designed to make you lose interest. They want you to sell your silver and go buy Nvidia or Bitcoin. Then, once weak hands are gone, we'll gap up to $90 overnight. Then another crash. Then another grind. It's a mechanism of exhaustion. They want to exhaust buyers psychologically. They want to make holding silver feel like a burden, not a joy. But while the paper price plays these games, physical reality will continue to tighten like a noose. Remember the 38 million ounces in the vault? While the price chops sideways, that number will keep ticking down. 35 million, 30 million, 25 million. The divergence between the paper game, the volatility, and the physical game, depletion, will get wider and wider. And eventually, the rubber band will snap. The target is $100. I have no doubt we'll see triple digits in 2026. The structural deficit caused by the China ban is roughly 200 million ounces annually. Investment demand is adding another 100 million. Supply from mines is flat or declining. The math is undeniable. We need a price that destroys demand. We need a price high enough to convince people to recycle their grandmother's silverware. $71 doesn't do that. $80 doesn't do that. $150 might start to do that. So the price has to go there. But it will go there on the bank's timeline, not yours. They're currently managing a controlled demolition of their short position. They're slowly covering shorts on the dips. They're slowly flipping their books from net short to neutral. And once they're neutral, once JP Morgan and friends have cleared their books of those toxic short contracts, then and only then will they let the price run free. In fact, once they're positioned long, they'll become the biggest bulls in the room. They'll use their media mouthpieces to pump the price. They'll raise their price targets to $200. They'll ride the wave up just as they rode the wave down. Because banks don't care about low prices or high prices. They care about being on the winning side. Right now they're trapped on the losing side. The volatility of 2026 is simply the sound of them switching teams. So how do you survive this transition? How do you hold on when the price drops $10 in an hour? How do you keep your conviction when the news tells you it's over? You have to stop playing their game. You have to stop looking at the paper price as a signal of value and start looking at it as a signal of opportunity. You have to adopt the mindset of the industrial buyer, not the speculator. Samsung doesn't sell their silver inventory because the price dropped $5. They hold it because they need it. You need to hold your position because you understand that the dollar is dying, supply is vanishing, and repricing is inevitable. We're watching the end of a 40-year suppression cycle. These cycles do not end quietly. They end with noise, confusion, and violence. Banks are going to kick and scream. They're going to break the rules. They're going to change the margins. But they cannot print silver. And as long as that fundamental truth remains, as long as the vault is draining, the destination is locked. The only variable is the path. So tighten your seatbelt. Do not use leverage. Do not try to outsmart the algorithm. Just hold the asset. Because when the dust settles and banks have finally finished switching sides, the price is going to a place where the current charts don't even have numbers. This brings us to the final piece of the puzzle, the strategy. We've discussed what they're doing. Now we need to discuss what you should be doing. We talked about the Japan trap, the danger of paying 80% premiums. But if you can't buy in Japan and you can't trust paper in Manhattan, where's the sweet spot? How do you exploit this broken market without getting burned? There's a narrow window of opportunity open right now, a way to use COMEX manipulation to your advantage before the door closes forever. Let's wrap this up with the battle plan. Let's examine the strategy. So let's discuss the Japan scenario first, because this is the biggest mistake I see people making right now. When you see headlines about Japanese buyers paying $130 an ounce, your instinct might be to panic. Your instinct might be to think, if they're paying $130, I need to buy now at any price before it goes to $200. You must fight that instinct. Paying a premium of 80% over global spot price is not investing. It's financial suicide. When you buy a bar for $130 while the rest of the world values it at $71, you're immediately underwater. You're handing nearly half of your capital to the dealer, the refiner, and the taxman. That premium is fear. The people in Tokyo are not buying silver because they're savvy investors. They're buying it because they're terrified their currency is about to evaporate. They're price insensitive. You are not price insensitive. You are a strategist. Do not chase the panic. Let the mob pay the panic tax. You're going to play a smarter game. The opportunity right now, the incredible ironic gift that manipulators have accidentally given us, lies in COMEX suppression itself. Think about what banks are doing. They're spending billions of dollars of their own capital to artificially hold the paper price down at $71. They're doing this to save their own skins, to defend short positions, and to prevent chaotic repricing. But their desperation is your discount. Because they're forcing the spot price down, they're effectively subsidizing your purchase of physical metal. Yes, you have to pay a premium. You might pay $5 or $8 over spot for a generic bar, but do the math. $71 plus $8 is $79. Compare that to the Japanese price of $130. You're getting the exact same asset, the exact same atomic element, for a $50 discount, simply because you're buying it in a market where manipulation is still active. This is the trade of the decade. You're essentially arbitraging the bank's own fraud. They're keeping the price low to hide the truth. You're using that low price to accumulate the truth. Every ounce you buy at $79 is a theft. You're stealing value from a system trying to deceive you. So the strategy is not to wait for manipulation to end. The strategy is to exploit manipulation while it lasts. Because once COMEX breaks, once registered inventory hits zero and they declare force majeure, the spot price will disappear. The discount window will slam shut. And suddenly, the price in Manhattan will match the price in Tokyo. You want to be the person who bought at 79, not the person waiting in line to pay 130. And this is the most critical warning I will give you. This strategy only works if you buy physical silver. I cannot stress this enough. Do not buy paper. Do not buy SLV. Do not buy mining stocks that are unhedged. Do not buy futures contracts. For the love of all that is holy, do not put your money into an unallocated pool account at a bullion bank. Let me explain why. Because banks will try to trick you. They'll tell you buying physical is expensive. You have to pay premiums. You have to pay for shipping. Just buy our unallocated silver instead. It's trading at exactly $71 spot price, and we'll store it for free. Sounds like a great deal, right? It's a trap. Unallocated means you do not own specific bars of silver. You own a claim on the bank's general pile of silver. You're an unsecured creditor. If the bank goes insolvent, or if they just run out of metal, you do not get silver. You get in line with the rest of the creditors to fight for scraps. And remember, part 4. The vaults are draining. Inventory is hitting historic lows. If you hold an unallocated account right now, you're essentially lending money to a bank that is short the very asset you think you own. When the squeeze happens, they'll settle your account in cash. They'll say, here's your $71, have a nice day. Meanwhile, the real silver, the physical bar, will be trading at triple digits. You'll have profit in fiat currency terms, but you'll have lost the purchasing power. You'll have missed the entire point of the trade. The only way to win this war is to take possession. If you don't hold it, you don't own it. It's a cliche for a reason. When you hold the physical bar in your own safe, you've removed all counterparty risk. JP Morgan can go bankrupt. COMEX can shut down. The Chinese government can ban exports. It doesn't matter. The bar in your hand is still silver. It's immune to their rules. It's immune to their failures. That's why we pay the premium. The premium is the price of freedom from the banking system. So here's your battle plan for the next 12 months. Step 1, ignore the volatility. Banks are going to smash the paper price down. They're going to create flash crashes. They'll try to scare you out. Do not look at the spot price as a measure of your wealth. Look at the number of ounces you own. Ounces are the scorecard. Step 2, buy the dips in the physical market. When banks smash the spot price to $68, do not panic sell. Go to your dealer and buy more. Use their manipulation to lower your cost basis. Step 3, watch the registered inventory numbers like a hawk. That's the real countdown clock. When you see it drop below 30 million ounces, you know we're in the endgame. That's the signal to stop buying and start holding tight. We're watching a slow-motion train wreck of the legacy financial system. Banks are hurt. Make no mistake about it. They're bleeding billions. Their vaults are empty. Their reputation is shattered. They're fighting a retreating war, trying to manage the collapse of their own suppression scheme. They're powerful, yes. They have capital, yes. But they're on the wrong side of history. You cannot suppress the price of a strategic metal forever when the world is running out of it. The laws of physics eventually crush the laws of finance. The squeeze is real. It's not a conspiracy theory. It's a mathematical certainty driven by the structural deficit we just analyzed. China has locked the gate. Industry is panic hoarding. And COMEX is running on fumes. The destination is $100 and beyond. The only question is, will you be holding the bag of paper promises? Or will you be holding the heavy, shiny reality of true wealth? This is John A.G. The analysis is done. The strategy is set. The window is open, but it's closing fast. Don't buy the hype, buy the metal. I'll see you on the other side. Subscribe and share.